Happy Monday, everyone. I hope your week is off to a great start. Today, we're diving into the latest updates on the labor market, the rising oil prices, and the inflation data that's set to dominate headlines for the week. So let's get started. Last Friday's jobs report painted a strong picture of the labor market, but consumer sentiment tells a different story. According to the University of Michigan's survey of consumer expectations, 50% of respondents in January believe unemployment will rise over the next year. That's up from 42% in December and 32% in November. The spread between those expecting higher unemployment and those expecting lower unemployment has reached 34%, which is the largest gap we've seen since December 2007 and January 2001. If you recall, these are two periods that preceded major recessions, so keep an eye out. This mismatch between reported data and consumer sentiments raises questions about the labor market's true health and suggests that there's potential revisions in the jobs data in the coming months. Now, expanded U.S. sanctions on Russian oil has pushed prices to $78 per barrel today. This increase is likely to push gas prices from the current national average around $3.06 per gallon to around $3.30 per gallon. It's a 10% increase. Higher energy costs could filter into inflation, adding pressure to the bond market. Now, inflation will be the big focus this week. We have two critical reports coming up. The Producer Price Index, referred to as the PPI, is tomorrow, and it's forecasted to rise about 0.33% month over month, which will push the year-over-year numbers higher due to a negative base number rolling off. The Consumer Price Index, referred to as CPI, is coming out on Wednesday. Markets expect another 0.33% rise in headline inflation, increasing the annual rate to 2.8%. Core inflation is expected to hold at 3.3%, but there's potential for a positive surprise from shelter costs. And on Thursday, we've got retail sales. We'll get a look at those retail sales, which will provide more insight into consumer spending and its impact on the economy. Now let's take a look at the market. The mortgage bonds down, about 9 to 10 basis points today. It's continuing the recent struggles that we've had over the last week or so. The 10-year Treasury sitting at about 4.78%, and there's some resistance right above that 4.8% marker. And if we pass it, there's potential to move upward to 5% if inflation data disappoints. In the short term, we're seeing some pressure on rates, but there's potential for relief if we get positive surprises in the inflation data or if oil prices stabilize. At this moment, if you've got a purchase going on or you have a lock that's floating, you might be inclined to lock it to protect against further volatility. Well, that's all I got for you today. Have an excellent rest of your Monday. Stay focused and let's make it a great week. Don't hesitate to reach out if you have any questions or you need insights for you or any of your clients. See you next time.